Topic examines the interaction between monetary policy and fiscal policy in maintaining macroeconomic stability, sustainable growth, and public confidence. Monetary policy is primarily conducted by central banks through tools such as interest rate adjustments, liquidity management, and balance sheet operations. Fiscal policy is implemented by governments through taxation, public spending, and borrowing decisions. The topic emphasizes that both policies must work together effectively because imbalances in one area can undermine the effectiveness of the other. During periods of inflation, tighter monetary policy may be required to reduce aggregate demand, while fiscal discipline can support inflation control by limiting excessive government spending and borrowing that could further stimulate demand pressures. The topic explains that central banks play a crucial role in preserving price stability and anchoring inflation expectations. By raising or lowering policy interest rates, central banks influence borrowing costs, investment activity, consumption, and financial conditions throughout the economy. Tight monetary policy helps control inflation but may slow economic growth and increase debt servicing costs. Conversely, accommodative monetary policy can stimulate economic activity during recessions but may contribute to inflationary pressures if maintained excessively. The topic highlights that monetary policy effectiveness depends heavily on institutional credibility, market confidence, and clear communication. Independent central banks are therefore essential for ensuring that inflation expectations remain stable and that financial markets maintain confidence in long-term macroeconomic management. Fiscal policy represents another key mechanism for influencing economic performance and financial stability. Governments use spending programs, taxation, infrastructure investment, and social transfers to support economic activity, reduce unemployment, and promote long-term development. Productive fiscal investments can improve productivity and strengthen economic resilience over time. However, persistent fiscal deficits and excessive borrowing may weaken public finances, increase inflationary pressures, and reduce investor confidence. The topic emphasizes that sustainable fiscal policy requires balancing short-term stabilization objectives with long-term debt sustainability. Poorly coordinated fiscal expansion during periods of high inflation may complicate monetary policy efforts, forcing central banks to tighten more aggressively and increasing financial market volatility. Topic also focuses on the risks associated with high public debt and the broader implications for economic stability and financial markets. Excessive government debt can create vulnerabilities by increasing interest payment burdens, reducing fiscal flexibility, and weakening investor confidence in sovereign solvency. Rising debt levels may also crowd out private investment because governments compete with private borrowers for available capital. The topic explains that debt sustainability becomes particularly concerning when economic growth slows or interest rates rise sharply, causing debt servicing costs to increase faster than government revenues. Under such conditions, governments may face pressure to raise taxes, reduce spending, or rely more heavily on central bank financing, potentially destabilizing financial markets and economic growth. The topic further highlights how high public debt can interact with inflation, monetary policy, and financial system stability. Large debt burdens may create incentives for governments to tolerate higher inflation because inflation reduces the real value of outstanding debt obligations. However, persistent inflation undermines purchasing power, distorts investment decisions, and weakens confidence in economic institutions. Financial markets may also demand higher risk premiums on government borrowing when debt levels appear unsustainable, increasing financing costs further. In extreme cases, concerns regarding sovereign solvency can trigger capital outflows, currency depreciation, banking stress, and broader financial crises. Effective debt management therefore requires credible fiscal frameworks, prudent borrowing practices, and strong institutional governance to preserve long-term macroeconomic stability. The topic concludes by emphasizing the importance of coordinated monetary and fiscal policies in managing inflation, supporting growth, and maintaining public trust. Policymakers must balance short-term economic stabilization with long-term fiscal sustainability while remaining responsive to evolving global economic risks. Structural reforms, credible institutions, and transparent communication are critical for strengthening confidence in economic policy frameworks. The topic also underscores that high public debt limits policy flexibility during crises because governments may have reduced capacity to respond to recessions, financial instability, or geopolitical shocks. Ultimately, sustainable macroeconomic management depends on disciplined fiscal policy, credible monetary policy, prudent debt management, and strong coordination among economic institutions to maintain resilience within increasingly interconnected global financial systems.